60,000 jobs could be eliminated from the federal government within the next 3 years. Will it affect you?
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson, joined as always by David Warren. We are both level 2 mortgage agents. David is also the owner at Referral Mortgages. We want to say a quick thank you to you for listening, putting up with us. Very patient, very loyal listeners. We also want to say thank you to our sponsors, Guertin, Poirier, Avocates Lawyers, Big Insurance in Westboro, and CENTUM. David, how are you doing? What's going on?
I'm doing fantastic. Fantastic. I feel like get through Mondays lately, and it feels like it should be a Friday. I don't know.
Yeah, well,
I don't know what it is, but
good news is Monday is a holiday coming up. So next week will, Tuesday will feel like Monday, Wednesday will feel like Friday, and there you go.
Tuesday will be even worse. Of an extra day of buildup.
The summer has been very strange. Like it feels as though like I've been trying to plan out some like excursions with the kids, day trips, things like that, and it's like we only got 4 weeks left. Like there's not enough time to actually get everything in. So I don't know. Summer is, for us, it's always a weird kind of time in real estate because it seems like every summer you kind of think you know what to expect, and then it's completely different. I know we were talking before we coming on air. I got a message this morning from Matt Bourneval, who was on a few weeks ago, and he was like, "Oh, what are you guys seeing? Like, has there been a slowdown?" And I was like, "Not really. Like, it's kind of been a typical summer. Like, people are still out shopping. I would say people maybe aren't as aggressive, but in the right property, they are. So it's like, I think as we've been saying for probably 6 months now, like homes priced properly are moving, homes overpriced are sitting, a lot of people out buying, still a lot of movement happening. Summer itself is weird. Spring and fall, we kind of know what to expect. Summer's a bit of a roll of the dice, but it seems like this summer has been, I would say, even busier than most, even though all the headlines are saying, prices are falling, homes are sitting, which is true, but homes are still moving. So it's very strange. What are you seeing, Dave?
A lot of the same, kind of one stat that we've talked about when the monthly stats come out is this year, condos, for example, have been absolutely hammered in Ottawa as far as pricing is concerned, sales volumes being down, things like that. But kind of to your point of places that show well, price well, are going or aren't as typical a unit, even on the condo market. A client of mine, they listed their condo. They bought a new home. They listed their condo, penthouse condo, I think 1.3 or 1.4 million. It was for rent or for sale. They have had no rental interest, all just every day flooded with showings. And I believe they even have just got it I think they were getting an offer shortly, but it's been on the market for only a week and a half, and they've just been absolutely flooded with showings. And it shows extremely well. It's a beautiful unit, but a high price point. I was expecting it to sit at that price point, especially where the condo market is at from a sales pricing being down and sales activity. So I was kind of surprised at that, really. But I think to your point, places, I think regardless of product or type, whether it's a townhome or single condo, again, like you said, price, good location, there's going to be interest regardless. So anyways, I thought that was pretty surprising based on where we've been at this year.
Speaking of that high price point, like I think there is still a lot of people, like we were talking recently about foreign buyers and them kind of being excluded from the market. But I think just in Ottawa, there's still a lot of people that are migrating here for work, for those tech jobs, et cetera. Tech is still obviously a massively growing industry, maybe more so than government, which we're going to talk on. But like Ottawa's kind of historically been like a very government tech focused town. And I think now there's kind of a heavier weighting on the tech side, which, as we know, there's a lot of money in the tech side. But to that point, at that higher price point, I've actually seen 2 properties in a neighborhood that I kind of keep an eye on here in Ottawa. One of which was listed at 7 million about a year and a half ago, and it's now down to 3.5 million. So like literally cut in half. Wow. And then another one was listed at 3.2, and it's now down to 2.4. So I think it's all relative, but I think in that price point, like it has to be a very specific buyer, right? Like you're not going to get some, the average family off the street going in at that price point. 1.3 now is kind of in that. I wouldn't say it's an average price point. It's still on the higher end, but I think, what 1.3 is today is not what it was 10 years ago. Like, there used to be
Mhm.
5 homes in Ottawa that were above a million or something 10 years ago. Now there's 100 or something, right? So
Yeah.
the dynamic is kind of always changing, but I guess it doesn't matter what your price point is. Like, you have to price your property accurately. Like, people have so much information now. Realtors have so much access to data that you're not going to be able to pull the wool over someone's eyes on a price point. Like, it has to be priced
Mhm.
properly. It has to be accurate to what the market dictates today. I think people are coming around to it now, at least sellers, but I think there was kind of that for most of this year, there's been that kind of, to be a bit more aggressive, I guess, like delusion of what homes are worth. Like, people are thinking their homes
Mhm.
are worth maybe 10% more than what they actually are, because that's what a home sold for a year ago or a year and a half prior. So I think we've seen that adjustment now. Now, where rates go, which I know we're going to touch on next, that's kind of going to have a real impact on prices, because as we know, usually if rates go up, prices either stagnate or come down slightly. And when rates come down, prices typically increase just because of that affordability. And if people qualify for less, they're going to pay less for a home. It's just kind of how it works. So what are you seeing and what do you expect? We have the Bank of Canada's rate announcement this week. Like, what are you hearing? What are the murmurs you're hearing through the grapevine of what's going to happen? I think everyone is on the same
Yeah.
page, but what are you seeing, David?
Well, so I think kind of this is kind of mixing up our order of what we of what we were planning on talking about. But something you mentioned about employment types within Ottawa, bigger push on high tech. Obviously we've talked about it before. Ottawa's always had a very stable federal, municipal, and provincial employment base, but there's been really this past week a number of articles that have come out where there's a push now, which I think is very different from what people were expecting of the Liberal Party, of actually reducing the public service employment headcount over the next few years. And I think we touched on it last week or the week before, of what the different heads of the departments have been mandated of finding a 7.5% reduction in expenses, and then 10, and working their way up to 15% over the next few years. But they're looking for a drop of about 57,000 federal positions, mostly within CRA, employment and social development, immigration, and that to happen by 2028. And it's stating in the report that it's roughly half of those job losses will be within Ottawa. So that, by 2028, so that 30,000, let's call it 30,000, even 25,000 jobs is a pretty significant, percentage of the employment base within Ottawa. Obviously, this isn't going to be one day that 25,000 are cut, and it's going to be an attrition over time. And, whether that's by 2028 or further. And it's a little unclear as to whether that's just these are some of those positions, people that are retiring and just not being replaced, and that's counting as a drop in employment base. Like, is it a full like packaged out, or whether it's just like eliminating maybe some consultants and people retiring? But that could have pretty big impact within the Ottawa employment landscape, which would obviously impact housing. So it's something we'll have to definitely keep an eye on as the federal government's kind of figuring out what that's going to look like for the cuts within their budgets in the departments, and how that's impacting Ottawa jobs specifically, because half of that within Ottawa is going to have a rolling impact. And whether obviously I would imagine the city municipal and has been watching this and are probably really well tied into this to really kind of help push that tech sector for getting that employment base up and things like that. So we'll have to keep an eye on that, but it kind of will play into kind of what we were just talking about. Is we have that Bank of Canada rate announcement tomorrow. It's a really busy day this week, or sorry, a busy few days this week between the U.S. and Canada, which are going to have drastic impacts on, I think, on the bond market, which affects the fixed rates, and not so much really at all on variable, but really just on the bond market. And it'll be interesting to see how that plays out. In the U.S. on Wednesday, we have the U.S. Fed rate announcement, which they're expecting a hold there as well. We have, GDP numbers coming out Wednesday morning before that Fed rate announcement. We're going to have, on Thursday, we've got a lot of the month over month and year over year income spends and job loss claims, things like that. So a lot to do with the employment base. Friday, non-farm payroll numbers from the U.S., unemployment rate numbers, manufacturing figures. So all of that data in the U.S., as much as it's in another country, really impacts our market, because these will have a direct impact to the the 10-year US Treasury bond, which is basically our 5-year government bond, which is what the fixed rates are tied to. They're not directly tied, but you can see over history that the two of them run in unison. So when the US Treasury is affected up or down on its yield, you'll see the Canadian bond move in the same direction. And then in Canada, we have obviously at 9:45 on Wednesday tomorrow, we have the Bank of Canada interest rate decision, and then we've got on Thursday our GDP numbers for May, our preliminary numbers for June, and then manufacturing numbers on Friday. So it's going to be a big week of figures, especially given that August is a hold on the Bank of Canada decisions, and they don't make a decision of what they're going to do with the overnight lending rate until September. So there's a pause through August, and then and then there's another meeting and announcement in September. So these numbers will be crucial for kind of leading that and giving us an idea of where we're at in both the US and Canada to kind of see what might be expected for the last little bit.
Yes. So I want to go back quickly. I'm going to touch on everything you said, but I wanted to go back to the CRA, like the jobs first, and then I'll touch on the rate stuff. So with the CRA, like I was going to jokingly say, like I hope that, because I know wait times are probably going to be increased with these cuts. But if anyone's tried to call CRA in the last 2 years, like the hope is that they do not get rid of any of those kind of service jobs, because that is really ultimately for the general public. Like we need those. We need to be able to talk to someone with these. Like these are very important roles that people play. Now, I think you mentioned like CRA, employment and social development, immigration are kind of like the main areas they're thinking about cutting. But in your opinion, like just specifically these jobs, a couple questions. So one, I know that both parties, as you said, like both the Liberal and Conservative Party the Liberals were not talking about cutting jobs, but the Conservatives, when they were talking about it, I think the plan was to, I think you alluded to, that like they would just let certain contracts expire and it'd kind of be like a slow attrition over time, not kind of one big massive sweep. Now this is saying they want to eliminate these by 2028. So it is about a 3-year time frame. Do you think that this is going to be kind of like let's say January 1st, your position's eliminated, or do you think it's going to be like a slow drip over time where, it might be 10,000 in a quarter, 10,000 next quarter, and kind of slowly drip down as contracts expire? And then to that question, do contracts, like I know a lot of people in Ottawa, when they retire, in quotes, they do kind of like independent contracts for departments within the government. Do you think part of this is going to be eliminating those types of additional contracts? You kind of mentioned that, but I don't know if those contracts are factored into these job numbers. Do you know if that's
I don't think.
part of it?
Yeah, they typically aren't factored into the job numbers, from what I understand, and that's where a few of the governing parties have kind of played with those numbers of calling it that they've reduced public service positions and reduced headcounts to increase efficiencies there, but then increased on the consulting side where like there was a huge spend there as opposed to which added up to billions and billions. So it was a way of kind of skirting that, and people on contract not also playing into a lot of those figures. I think it'll be a combination of all of it. I think there has been already announcements, and I can't recall off the top of my head, but I remember there being some announcements around the kind of reducing the number of consulting bodies to reduce some of that cost. But I believe this is just strictly in the full-time positions. I think it'll be a combination of contracts, people retiring, not being replaced. I think people that are inefficient or in departments that aren't needed or that technology is able to assist with, I think those positions will be kind of shed.
Yeah.
And I think it'll be contract positions being, not renewed. But I think by 2028, I mean, there is a huge investment right now ongoing into technology, into AI. We're very behind the ball as far as AI is concerned. And I'm sure there's a lot of areas, and we see it, I'm sure, in every, like I know I see it in what we do, and I'm sure everyone listening also sees it in their industries of AI, increasing efficiencies in one factor or another, which when kind of combined will allow for, or rightly and wrongly, of some of these positions, not being needed or these contracts not needing to be renewed because over the few years that they're able to bring in tech, which kind of eliminates bodies because you're kind of reducing maybe a bottleneck. Or, when you talk about a CRA customer service line, AI call centers can cut that down as well. And we see that with a lot of companies and big companies that, those AI call centers where you don't even know that you're not speaking to a human is able to get 90% of the answers that you're looking for, and then is passed on to somebody else. So it can definitely increase kind of efficiencies there. So yeah, I think time will tell really what that severity is, and whether these initial numbers are just to kind of, whether it's actually just headline grabbing, or whether it actually comes to fruition of these cuts.
Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big. Protect what matters most. Are you trying to grow your mortgage business? CENTUM has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with CENTUM. Learn more at joincentum.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Guertin, Poirier, Avocates, Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at guertinpoirierlaw.ca. Let's get to the heart of your deal.
Yeah, and I think touching on that AI quickly, I think that the technology itself is exponentially growing. It's not something where I remember they showed us, I think it was about a year and a half ago at one of our conferences, they showed us this guy called into this number. It was an AI bot, and it basically asked them questions about a mortgage and what they're looking to do, and they can schedule a call. And it was pretty good, but you could tell it was still a bit choppy. There's a bit of a delay after the question to the answer and so on. But a year and a half later, it's completely seamless. You literally can't tell the difference. And that's only going to get better. It's certainly not, it's not going to decrease in efficiency over time. It's only going to get better literally by the second. And a lot of these AI systems, they don't need to sleep. They don't need to eat. They're just constantly improving themselves 24/7. And there's a lot of jobs I think people are not thinking could be replaced that will be replaced. And that's going to kind of, the hope is that when these things come in, it makes things more efficient, costs less money, and allows people to have more, autonomy, more freedom, more time, more money in their own pockets. So now it's kind of a race to see is the savings going to be passed off to the general public, or is the savings going to be passed on to the developers of these programs and make themselves wealthy while, leaving the general public behind? So the hope, I think, in eliminating some of these jobs is that it actually saves money for the federal government, and that gets passed on to all of its citizens, right? Now, historically, does that happen? Up for debate. But that is the hope, I think, is that, we can make things more efficient, save money, and basically benefit everyone, everyone that's part of our community. So yeah, very interesting. I'm very interested to see where the next few years go. And like you said, even in our own industry, we've seen, I know Ron Butler talked about this, and a lot of there's a lot of podcasts focused on real estate that have been talking about this kind of shift to a lot of these assistants and so on that help expedite a lot of the processes involved with the mortgage process. Talking about rates, because I know you touched on that, there was an article by Canadian Mortgage Trends that you had shared with us recently. So I just want to summarize that, and then we can kind of touch. I have a few charts. We can dig a bit deeper into the rates. So it says in its July 2025 forecast, RBC now says that it expects the Bank of Canada to hold its overnight rate at 2.75 through 2026, effectively ruling out future cuts for the remainder of the year. The shift reflects sticky inflation and reduced urgency for monetary easing. Other banks like BMO, Scotiabank, TD, CIBC, and National Bank are more dovish, projecting possible rate cuts to between 2% and 2.5% by early to mid-2026. Market watchers cite mixed economic signals, slowing growth, resilient core inflation, and trade uncertainty complicate the outlook. With that inflation sticking above target, is there a risk that the bank will need to hike again, or is holding kind of the norm here? What do you, if you could have a crystal ball, Dave, see into, let's say, 18 months down the road, is there a likelihood or even a potential that rates could tick up? Or is this something where it's okay, let's just hold as long as we can until we have to ease.
Yeah, I'm not an economics expert. I do rely on kind of looking at what the chief economists of the different banks are doing and where they're deriving this information from. RBC is one that is saying that they're holding. However, the others, all of the other institutions are looking at a drop. CIBC and Scotia particularly their chief economists are very focused on real estate and understand that. And I think, CIBC, Benjamin Tal there is probably the leading economist with regards to that. And JP Perot from Scotia, again, similar. And they're two that I definitely read, their articles and follow them because they really parlay what is going on in the economy of how it impacts the Canadian real estate and mortgage industry and market. So for anyone listening, certainly those are two names to look up if that's of interest to you. But I do think that there will be, again, it also depends on where these figures go from this month and next. We only have 3 more announcements the remainder of the year. This will be a hold tomorrow, but what it looks like in September, to be seen. But it's going to be a lot dependent on that. It'll also depend on what happens with August 1st. Friday is another looming day of Trump tariff watch and, supposed to be enacted as far as like that's concerned and whether 35% sweeping across the board comes into play or whether they actually, make headway on a negotiation or what happens there in that posturing is going to be indicative. That's going to play a huge part into what happens with the Bank of Canada and the overnight lending rates. But I do think we're still going to see a reduction over time. It's not going to be anything drastic. I think it will be another one through the end of the year. But, again, that's just me looking at, looking at the top 6 banks and, looking at the consensus across the board is, and what they've been indicating is that there is going to be at least one further rate drop. Again, there's a lot of things that can come into play with that, but I still believe that variable is a great way to go for any of you that have renewals coming up. I think if you have an offer sitting in your inbox from your current institution that has a 3 in the front of it for a fixed rate, I do think that it's worthwhile for you to just accept that rate because rates have ticked up, fixed rates have ticked up. Unless we start seeing some real negative news, we won't see those bond yields drop at all. But yeah, again, like it's all data driven, and so we'll see. We've got these banks predicting what's going to happen, but that's based on again what's hopeful. But there's huge looming aspects that we can't control, being the U.S. and how their economy's doing. They have a huge bill that was just passed of $3 trillion. How that's going to play into inflation south of the border, which then has a trickle effect to Canada, and then tariffs beyond that. So lots to keep an eye on.
Yeah, I think that's kind of the same conversations I'm having as well. Like I'm talking to a lot of people who are inquiring about their upcoming renewals in October, November, and the rates they're getting from their lenders are 4.04, 4.06, 4.09 for 5-year fixed, and like those are, like you said, like 3. If you're getting something in the 3s, I mean, start the car, right? It's like, let's get out here, sign it and run. But I think generally speaking, like anything in the low 4s right now, like you're going to be ahead because the likelihood is, at least with the numbers that are coming out, even if they're surface level optimistic as far as like job numbers and stuff, we talked about that a few weeks ago, like, feds are talking about cutting 60,000 jobs, but I think the last job numbers that came out said it was, 70,000 jobs created. Now, most of those are part-time jobs. So that's why I say it's kind of like, it looks on the surface like it's really positive, but the underlying issues may be more profound than people are kind of giving weight to. So who knows where the bond rates are going to go? And there's so many other factors. Like you said, all those US numbers, like all of these things impact the bond rates, which then impact the fixed rate. So we could very likely see bonds go up even further and fixed rates continue to increase. So if you're getting a fair offer, and that's kind of what I'm seeing is people calling about renewals, they're getting offers that we just can't compete with currently with their current lender, which is great. And I'm like, we're the first to tell them, like, that's awesome. Take it and go. Like, but that's kind of, banks are probably thinking, well, we can, there's a lower cost acquisition of these clients. We already have them. They've paid all their mortgage payments on time. So let's give them a competitive rate. There's no cost to acquire this client. where typically there's, thousands of dollars involved in acquiring a new client. And, they can offer them that rate and give them a bit of a savings, which is kind of a win-win for the lender and the client, right? So we're seeing that more and more. And I think as rates continue to creep up, that's going to be a way that lenders, because they're not getting a lot of new business in for purchases potentially, or at least a lower amount, that they're going to be more aggressive on maintaining or retaining those existing clients.
I'd say it's a mixed bag for people that I've been speaking with, of those getting really good offers and those getting pretty poor offers. And and what I mean, and in a lot of cases, the poor offers are more so in how they purchased the property originally. And so I think, something we spoke about quite a while ago when talking about renewals is that banks, when you purchase a home, you put 20% down, a 30-year amortization, it's coded in, let's say, TD Bank. They'll have it coded in their system as a conventional mortgage. When you're at 25 years, so the rates are going to be based on a conventional mortgage offering of what they're going to offer for that renewal. However, you can look to switch to another bank where they can offer what's called an insurable rate, meaning that it's at a 25-year amortization. You're under certain parameters, like original purchase price or value being under, $1 million, things like that. And you can look, and there are some other better offers out there. It just depends on how it's coded in their system and what type of product you're needing to maintain with. So I find but that's more so in the broker channel for a broker, that we have those added tools in our toolkit that the major banks don't have that ability to offer insurable rates or, this other bucket of rates and things like that can be more competitive. So I find it's, in some cases, it's like those conventional rates that they're being offered or insured rates just to renew dollar for dollar. And they're still in that bucket of conventional, or they're still in that insured and they just want to renew. Like a lot of those are being offered at drastically lower rates than what would be available. But those that now fall into that new bucket of rates that they have available, that big sixes don't, that people can look to move and be competitive, or take the time that maybe it's just not renewing dollar for dollar. That doesn't make sense. Consolidating debt makes sense, even if it means switching institutions, or even with the existing of refinancing to pay off all of that consumer debt. So there is like long-winded way of saying I find it is like a mixed bag, but no matter what, when we talk about rates, still shop around, get a quote from your existing bank and take that to a broker and have them provide that honest feedback of whether that's a good offering or not. And a good broker will tell you immediately, yeah, this is a really good offering.
Yeah.
Like you don't need to do anything, just accept it. Like, I'm not going to be able to do any better, because moving banks for the sake of moving isn't beneficial. You're just going to go through like legwork unnecessarily. But if there's a cost savings there, then absolutely look to it.
Yeah, that's a good point. I have had a few that were like not even remotely competitive, like in that exact situation. Like they're being offered 489 or 494 for renewal, and I'm thinking like, that's crazy. Like we can definitely beat that, So it's exactly that. Like they're kind of going from a conventional into now what's considered insurable, so they're able to get those more competitive rates. There was a quick article we wanted to touch on here, just with regards to kind of a follow-up from last week when we were talking about cross-province transfer of materials and things like that. So there was an article that we were reviewing this morning. It says home builders navigate higher material costs in uncertain supply chains amid the trade war. So talking about like kind of the tariffs and so on. So quick summary, it says Canadian home builders are wrestling with sharply rising costs and supply chain disruptions tied to the U.S. trade tariffs. Appliances, interior doors, and carpeting are among the most affected inputs. Some builders are switching to alternative materials, so vinyl plank instead of carpeting, etc., or sourcing in the U.S. and absorbing those tariffs. So the uncertainty is slowing builds, squeezing margins, and raising affordability concerns. So, like, given these kind of rising costs and delays, do you think this is going to have a direct impact on home prices? I feel like it has to, right?
Yeah, I think it's kind of similar to what we were talking about last week when referencing like small businesses and businesses in general with inflation of, kind of eating it into their margin. And there's only so long that can go on for. Right now for home builders, they're either just not proceeding with a project because of the high costs, and they're just going to wait it out to see like when things stabilize, because you've got rising costs in materials, but also a slower market in a lot of these major markets from a sales volume perspective. So there's, those two negatives working against, kind of that uptick in new housing starts. But as they do build and these costs go up, they're going to, they will absorb them a little bit because they want to move that product, and they've been maybe sitting on that land and that project for, 10 years. and they need to get it going to kind of keep things moving along in their pipeline. But they're going to have to at some point start passing along that rise in costs to others. I think probably a lot of builders are the bigger builders. The smaller ones they're going to be harder hit because they don't have that economies of scale for ordering in bulk, or that they don't have the warehouses that some of these larger builders have that they can stockpile materials in and buy a bulk, at times where costs are lower or tariffs haven't kicked in yet somewhere, and they kind of have their ear to the ground of knowing when that's going to happen. So they're purchasing a lot of these materials or just sourcing them from other countries and not just the US. So I think those, just like anything in any industry, the small businesses are the ones that are going to be hit the hardest. And in this case, these smaller builders, which is unfortunate.
Well, on that note, David, let's change the mood here. Let's change the vibe. Let's get into some
I agree.
losers. I think they're all pretty good. Here we go. Number 1, I had a new neighbor move into my neighborhood and asked me if the tap water was safe to drink directly from the tap. My response was, it is, but most people use a cup. Delivery could have been better. Number 2, where did Noah keep his bees? In his archives. In his archives. Yep. Number 3, I told my girlfriend she drew her eyebrows on too high. She seemed surprised. Uncle Leo,
I like those last two. Those last two are good.
Oh, that's great. Well, thank you, everyone. Thank you for tuning in. And thank you as well to our sponsors, Guertin, Poirier, Avocates Lawyers, Big Insurance in Westboro, and CENTUM. We appreciate your support. We appreciate all of you as well for listening. And be sure to check out our socials. And we'll be back next week, Wednesday, 10 a.m. We'll see you then. Have a great week.
Deuces.